Beta, it can be understood as how much the asset price moves when the market price moves. In other words, how sensitive the asset return is relative to the market. And as you can see, the formula is very close to the correlation, but it's not the same thing. Beta keeps the sign and direction of the relationship, and this is from the covariance, but the denominator is the variance of the market, so the scaling is only relative to the market. And just a quick way to map it, a beta above 1 means that the asset moves in the same direction but more, so it amplifies market movement, like for example growth stocks. If the beta is 0, then it means that whatever happens to the market, it doesn't have any effect on the security. And if it's negative, this is an interesting one because it's going against or in a direction that is opposite to the market, and this allows to increase the diversification effect because you want also assets that go against, if you want, the normal movement. And that's the idea of hedging. It's using positions that offset each other's movement. So, quick note, if you manage a portfolio that has a beta that is close to 0, so it doesn't really care what the broad market is doing, and you still deliver a positive excess return over the risk-free rate, then you're generating an alpha that is independent of what happens to the market, and you're making money regardless of whether the market is going up, down, sideways. And this is, if you want, the objective of long-short hedge funds usually.